or rallies or sell-offs. I have to say, I'm calling for a melt up to 6,000 on the S&P, 20,000 on the NASDAQ, 45,000 on the Dow, 3,000 on the Russell 2000. So these are big runs from the lows of March 20 when I sent out that tweet, and that was the low in the equity market, at least to date. Those are, 50, 60, in NASDAQ's case, I think an 80% run from the low to my target. And I'm talking about seeing those peaks this year and probably in the next 3 to 6 months. That's insane. So I get it when people look and see a Fed that looks like it's going to have to hike rates and is indicating that it plans to hike rates for a good long time, that it's just beginning QT to shrink the balance sheet, that inflation's a lot. There's a huge spread between the inflation rate and the Fed funds rate or any of the Treasury bond rates. It's hard for anybody to wrap their arms around why would somebody be calling for what looks like it may be the biggest rally in history, biggest, steepest rally in history, at a time when the Fed's clearly indicating they plan to tighten a lot more, they plan to fight inflation, and they've come out and said, we don't really care what it does to the stock market. We're no longer your savior. There's no Fed put. We plan on pushing stocks down to dampen wealth and hopefully take some of the air out of inflation. And I get all of that. I'm not making my forecast blindly, but I think what people are missing is how much of the tightening has already taken place, which means the bond market, when you had the spike in rates earlier this year where, the 2-year went from, I don't know where it was, a quarter and a half up to, 2 3/4, and the 10-year went from, 120 up to 316. You had more than 200 basis point hikes in these rates because the market was ahead of the Fed. The Fed dragged their feet, but the market didn't. The market saw the inflation and reacted. Those big changes, rapid changes in rates, even though they're still relatively low historically, to raise rates so quickly, so dramatically, has had an impact on consumer spending.
Yep.
It's had an impact on housing. And I think when you look at the inventory levels at places like Target and Walmart and some of the other inventory numbers coming out of the retail sector, we're in for a good old-fashioned inventory correction. And inventory correction is, in at least when I went to school, is basically a definition of what a recession is. You have to correct those inventories. When they stop ordering and work down those inventories, that means it moves back through the production end, and you stop producing because you're not getting the orders. So manufacturing takes a hit. That's how an economy slows down. The Fed's thinking the economy's strong, inflation's strong, and they think they have to hike rates. They've already said 7 times this year, maybe 7 times next year. They're not going to get close to that. I'll be surprised if they get beyond July. You got a 50 basis point hike pretty much baked in the cake for June. They claim 50 in July. I think by then it's going to be pretty clear that they've already done a lot of damage. And Fed record is not good on soft landings. They say they want a soft landing. If you look at history of Fed tightenings, they have caused every recession. And we know from what happened in 2008-9, it was a pretty dramatic so-called Great Recession. They always go too far and don't anticipate the damage they've done. And I put it very simply, it's because they don't understand the leads and lags to policy. So they're judging when to stop policy by data points. So they look like today a manufacturing number came out, a PMI manufacturing number came out, and it was higher, went 56 and up from 54 or something like that. So it looks like manufacturing is still relatively robust.
Yeah.
Yeah, but if you're an economist, you should be looking at the things that lead to what's coming down the road and saying, oh my goodness, inventories are up housing's starting to roll over. Maybe we need to worry that we've gone too far already. They're not of that mindset yet. But I think in the next couple months, data is going to be weak enough that they may wake up to the fact that at the very least, we need to pause.